Welcome to the Money Pig Podcast, presented by Goodwin Investment Advisory, where our mission is to lead you to financial pig, peace, independence, and generosity. I'm your host, Tim Goodwin. So welcome back to the Money Pig Podcast. I'm here with Ray Brown today, and we're going to be talking about when and why you should consider a refinance on your home. But before we do, Ray, do you know which state has the most streets?
Oh my gosh, I have no clue.
Rhode Island.
I was not, okay. Wow, there we go. There we go.
You got to get that dad joke out of the way.
You got to warm it up fresh.
All right, so we'll dive right into this very exciting topic about refinancing your mortgage, but it is a big deal. So many of us have mortgages. So so give us the intro here. Why is it even important to think about refinancing your mortgage?
It's a great question. Yeah, rates are important in general. I mean, we talk about savings accounts, we talk about what money markets are paying, and we talk about what's our interest rates on car loans, house payments, all those great things. So yeah, we love to save money when we can. So when rates drop, fantastic time to save on that, the P&I, principal and interest. So
yeah. Okay. Yeah. Actually unpack P&I for a little bit. So you got P&I and then you have PMI.
That's right. Two totally different things.
So when you say P&I, you're talking about
principal and interest.
Okay. But PMI
is no good. We want to avoid PMI. That's
just like PMSing. We
yes,
want to
avoid that as well. Yes, please. PMI, private mortgage insurance.
Yeah.
That's actually an insurance product you get charged for as the borrower, and it's for the lender. You're paying their insurance coverage because for whatever reason.
Am I always getting charged that PMI?
You should not always get charged that. It should, once you cross over that 10 or 20%, it's actually 20% threshold for your equity. Once you've built up that much value in the home, the PMI will drop off.
Nice.
But you have to request it. That's another thing a lot of folks forget about.
Awesome. That's exactly what I was going to ask. Like, do I have to refinance my mortgage to get my PMI insurance payment off? Like, let's say I put 5% down on the house, right? I got to pay the PMI insurance premium that you're saying because I'm not at 20% or more equity yet. But
That's
when
correct.
I am, do I got to refinance or can I just call?
You can get around doing the refinance. Yeah. So you can call in, unless of course it makes sense to do a refinance at that time, which is what we're talking about today. But I think, generally you do have to just call in and request that or submit a request in writing and request that to be dropped off. You know, it sometimes requires an additional appraisal. So there could be some expense added to the process, as you know, but then, hey, we're saving a couple $100 a month or at least $100 a month, whatever it is.
Well, that's a great trigger, right? Yeah. So if you're at 20% or more of equity in the house and you've been paying PMI, at least make sure that you get that PMI off. May also be a good time to consider refinancing if rates have dropped.
Absolutely. Yeah. Based on the market conditions. It's one of those things, people that, if you've got a historically low interest rate, well, that's gold. You don't want to let go of that. We're not moving anytime soon, but if you bought a house during a time where rates are really high, then certainly could make sense to take a look, see where rates are at today, see if you're either going to be up or down. Yeah.
What are some other reasons I might consider refinancing?
Well, one that I think of often is folks that, you bought in at a historically low interest rate. Maybe rates are really good, 15-year mortgage. Mm-hmm. You got a higher monthly payment now. That PMI payment is higher because you've gotten, your term is over 15 years. If you wanted to reduce your monthly payment, you could turn and, the rate could stay the exact same, but you could change the term of the loan. So of course, we think of refinance. I think most people think of it as we're dropping the rate, but you could also mess with those terms. You could go from a 15 to a 30 or vice versa, or just even kicking the can down the road. Say you're 5 years into a 30-year mortgage. Well, now you can start over again with 30 years. Not know that we necessarily recommend that. I think all of us are anti-debt. We want to get these mortgages knocked out as quick as possible is generally the advice. But if for some reason you're looking to lower that monthly payment, you could certainly look to a refinance to achieve that.
Another reason might be that when you got your mortgage, maybe your credit worthiness wasn't that great. Right. You didn't have a super high credit score. Maybe your income was a lot lower. Maybe your debt to income ratio was high. Right. So maybe it was a lower interest rate environment.
Right.
But you hadn't really buttoned up your credit. Like, for example, my wife and I, we were like super duper experts at debt. We tried them all. Right. We gave them all a chance. We had a lot of debt a long time ago. And so before we cleaned that up, we didn't have as good of a credit score. We weren't as credit worthy. Even if our credit score was good, we could add a lot of debt, right? So that could affect the rates. So even if the rates haven't dropped, but your credit score has improved, Would that be
definitely?
Would you think that's a good time to consider?
The better your credit, the better your rate's going to ultimately be. Factors in, a lot of contributing factors, as you said. The income matters, and so taking a look and just see the rates. And the important part is to compare that to what you're at right now. If you've already got the home, you're already making payments. Let's just check it. Rates don't stay flat. They're constantly moving. Daily they fluctuate, and so it's either going to be better or worse. So
Now, I think often we see that once you've committed to a mortgage, you have to pay closing costs to get a mortgage, right? So like refinancing your mortgage, you've got to consider these closing costs, right? Like people aren't refinancing all the time, and every time the interest rate drops a tiny bit, because there are these closing costs that need to be absorbed.
That's right.
I have heard of mortgage companies that one of their ways of competing or getting you to use them is that they will refinance you for free. Mm-hmm. They probably limit how often that is or how far it's spaced apart. Now, I think, my experience that I've heard, and I'd be interested to hear if you think any differently, is about 2 years. Like generally it's taking somewhere close to 2 years to sort of absorb the closing costs into the reduced interest rate. But again, I guess you really just need to look at how far the interest rate dropped.
I would say 2 years makes sense. I've heard similar. I've also heard from a percentage standpoint, people, hey, it drops 0.1%. And it's like, well, I'm going to run out and go do this right now. And it's like, well, by the time you add in those loan fees, the origination fee, you got to get it reappraised. You're asking a new mortgage company to take over your loan. So they're going to make sure it's worth what you say it's worth before they go writing the check and paying off your old mortgage. So generally that 0.5% mark, I think, is kind of what I've heard. But again, that's just a rule. I was looking at interest rates this morning just for fun. I'm considering a refinance myself. And
look at this right
sometimes
here.
The
Live
rate
example, everybody.
The rates come with, can either come with points, where you're prepaying a little bit towards interest,
but it can also paying it down, bringing a little more to the table.
Yeah, you're bringing a little more of a fee to get the rate. But then also the opposite of that, which I'm a huge fan of, is getting a little credit. So it's like, if you can find an attractive rate that comes with a little bit of a lender credit, okay, this helps kind of offset some of those costs to you.
The lender credit, that means they're discounting the rate?
Exactly. Yeah, they're actually issuing you a little bit of payment with the rate. So that kind of comes to the table and helps offset some of those costs. You can potentially get a refinance where you don't have any net cost to yourself other than, because they're going to pay it with lender credit.
Nice.
So you're slightly higher than interest rates, but depends on the options, depends on the timing.
So the other one that comes to mind for me is, because you got two different kinds of rates. You have the fixed rate and you have the adjustable rates. Right?
That's right.
And those adjustable rates can float.
Yeah.
Right?
Which could be a good thing or a
good thing or a bad thing, right? If rates are going down and you're on your adjustable, you feel really good. But if rates are going up, you don't. So, and maybe when you got the mortgage, maybe your options were limited, based on your financial situation or what you were buying.
Sure.
And so I think sometimes people might consider refinancing because they want to fix a rate.
Yeah.
Or they project interest rates are going down, and so they want to switch to an ARM, an adjustable rate mortgage, and head down with those rates, right? So that might be another reason.
Changing the type, and absolutely.
So I want to come back to this change in terms, because this is the Goodwin Investment Advisory Money Pig podcast. So I'm going to probably throw out a little bit of ITO in Tim's opinion.
I was about to say, what is ITO?
ITO.
That's a new one. Yeah. Write that down.
Add that to the acronym glossary.
Yeah.
So, we're here in Georgia. This is where folks, typically, I think it's end the Appalachian Trail or start it, but we're at one end. I'm trying to think, generally depending on the time of the year, where you start or end. But hiking the Appalachian Trail on average takes about 6 months. Okay. So if you liken 6 months to a 30-year mortgage, okay. So I'm going to start the AT, right? Let's say I hike in like 2 months.
Right.
2 months I've been hiking. I'm heading to Maine.
Yeah.
Trying to get there before it's cold. But let's not talk about weather in this case. So, but I'm 2 months in, right? I got 4 months to go. I'm a third of the way. So let's say, like, if we're likening this to a 30-year mortgage, I'm 10 years in, right? I'm a third of the way in. There's 20 years to go.
Right.
And I think if somebody came to me after those 2 months and was like, hey, Tim, I've actually got like this better gear. Like I've got some better shoes, lighter backpack, this little jet fuel thing's super cool.
Yeah.
It's going to last longer. This backpack's like, it's actually wicking and, it's going to keep you warmer and drier. And you can use all this, but you have now, even though you've come too much, you've got to slow down. and it's got to take you, even though it's normally going to take you 4 months, it's now going to take you 6 months to finish.
Right.
I think at that point, I'd be like, nah, bro. Like, I'm not slowing down. I'm 2 months in. I'm just going to finish this out with my ratty shoes. Yeah, leave well enough alone. So sometimes I get concerned when folks just refinance too often, especially if they're not refinancing into the remainder of their loan. So if I'm 10 years into a 30-year, if I refinance into a 20-year, then I still finish I planned on starting. But if I'm in 10 years and refinance for another 30 years, I'd still extended it.
That's right.
So I'm not a huge fan of, like, you're just never going to be done, right? You run into folks where you meet older folks that have just never finished paying their mortgage off, but they started buying homes 50, 60 years ago.
You're kicking the can down the road.
Yeah. And I just speaking personally, you know, you're talking about refinancing. I bought my home on a 15-year mortgage, and it was really hard at the time when I looked at that payment.
Oh, yeah.
I'm like, this is going to be...
I don't think it's ever going to feel good.
This is not going to feel good, you know? And I have gotten a lot of offers over the years to refinance, you know, and you could get a 10-year mortgage. That's not unheard of. But once I got inside of the 10-year window, and I'm inside that 10-year window, I can't refinance from what I understand. Sorry if there's any mortgage brokers listening going, yeah, Tim, there's a 5-year mortgage out there. I wasn't aware of a mortgage term that was less than 10 years.
That's where it gets really tricky.
I'd rather just finish what I started and be done.
Yeah.
You know,
get that thing done.
And I'm grateful for, you know, debt has gone down and income's gone up over time. So the payment's nowhere near as hard as it was when it got started.
Yeah.
But that kind of comes back to the old adage of no pain, no gain.
That's true. I mean,
pay now, play later.
Yeah. I mean, when you look at a rate reduction, it's okay. You can see what your principal and interest change is going to be per month, but that's based on the term. And so, obviously if you've got a 15-year mortgage, your P&I payment is a lot higher. Regardless of interest rate, you're paying more than the guy with a 30. And so, which is kind of the point. And so, dollars going out the door each month towards interest, it could be, you could very well have more going to interest in a even a different term type environment, you know? So got to compare all apples to apples.
We're big Dave Ramsey fans and getting out of debt. And one of his sayings that he was the first one I've ever heard say it like this. He said, "What is your greatest wealth building tool?" You know, do you remember what he said?
Your income.
Your income.
Yeah.
Your income. Listeners, just so you know, I did not tell Ray I would ask him that question in advance. Like he knew. Like Dave Ramsey says, your greatest wealth building tool is your income.
And when someone brings up Dave, I'm like, I wonder what the quote is. Like, I know. It's like a little secret game I play with myself. That's right. Yeah. Quoted him this morning to someone.
You nailed it.
He's got some great ones.
So when your greatest wealth building tool is your income and you've committed so many things to payments, even if it's 0%, that payment means you have less wealth to build income with at the end of the month. And so even though I don't have the lowest interest rate mortgage that I've ever heard of, I have plenty of clients that have lower interest rates on their mortgage than mine.
Yeah.
But I just didn't want to reset the clock, the time period back further.
That's right.
So that I could get this paid off and kind of help me build wealth. Or maybe I don't need to build it, but maybe I can take my family out more. My kids will be in college. I'll be able to help cash flow at that point.
I've talked to clients too, and even in the personal life, friends and family that say, you know, have you heard? I'm sure you've heard this one a ton, Tim. I'm going to get the 30, but I'm going to pay it like it's a 15. Yeah. It's like if I could count the number of times someone has said that, and then I check in and I'm 2 years later and say, you still paying it like a 15? Like, no, why would I? I'm freeing up cash flow. I'm keeping that money in it's like, there you go. You're paying more in interest, even though you've got a difference. So that's important to think through too. I mean, in your example, sure, I guess, you've got 10 years left. I guess you could refinance to a 20-year, and then you could tell yourself, I'm going to just pay double every single month. I'm going to make sure I hit this. I got my rate lower, so less is escaping out the door to interest. But that just requires a whole nother level of discipline. And no matter how many people say they do it, it's just, are you really going to do it?
Yeah. And to me, I'm like, look, if you're already thinking and saying out loud that you're going to make a double payment and pay it like a 15-year, just get the 15-year because you'll have a lower interest rate. You'll have a lower interest rate on a 15 than you will on a 30. Yep. And it'll hold you accountable to getting it done.
That's right.
And kind of like you were alluding to earlier, that you get on a 30-year mortgage, you start those payments, most of that payment goes towards interest, the way they do the amortization schedule. But you get in that 15-year, you're starting to eat away principal really, really fast.
It's quick. You build it fast.
What'll screw with your head is when you look at that number, when you sign that 30-year mortgage and you realize that like the total amount that you will pay them over 30 years is probably over double the value of the home you're buying.
Yeah. Oh, yeah. Compare
So
that
like,
option
you're
to
going to pay for the house twice.
Compare it to a 15-year. And at the end of the day, pay it off as quick as possible, but certainly, just exploring options.
And I think when we talk about dreaming and we talk about retirees, when a client is asking, hey, do I pay off my mortgage or not? Maybe it's a low interest rate, And a lot of times I will appeal more to the right side of their brain, more to like the emotional side and just be like, did you ever dream of being retired with a mortgage? And I think I've actually got this other image from Dave Ramsey. Like, wouldn't you love to just be barefoot in the backyard in the grass and just be like, I own all this.
The grass.
It's not partly owned by the bank. What were you going to say?
I was just going to say, the grass feels greener.
Grass feels greener when it's all yours.
I've heard Dave say too, something he brings up a lot is like, if you pay off the house and you absolutely hate that feeling, you could always go get another mortgage.
And get it back
You could go borrow the money on that. And it's like, who's
his
other
do real funny quote on that one is, he's done really in-depth research and 100% of foreclosures happen on houses with a mortgage.
That's a great one, yeah.
So, so the other thing I think I'll share here too is that why not just, because it depends on what circle of life and sphere of life you're in. But a lot of times we feel like everyone has a mortgage on their house. That's not true.
It's true.
It's like over a third, maybe up to 40% of Americans own their home. So just join that club. Let's just join that club.
Yeah.
But do it, intelligently and thoughtfully, and certainly consider these interest rates and these closing costs.
Yeah.
But don't just keep resetting the clock. You'll never get the sucker paid off.
That's true.
Any other final thoughts on it?
I think that you hit the nail right there. That was my big takeaway at the end. It's just comparing the options, truly looking like apples to apples. There is more to the equation than just what's the interest rate when I got this thing versus what are they today? Do I refinance? And it's easy to reach and to say, get this application going. But it's like, wait a minute, there's other costs to consider. And so certainly want to look at all that. Yeah. See when it makes sense.
All right. So before we sign off, I wanted you to share something that you're grateful for.
Oh, man.
Yeah. Just shifting all over.
Didn't expect you didn't give me a warning on this question either, man.
You'll know for next time.
I thought there's something I'm grateful for. It's funny. My wife and I, we just started doing the 5-minute journal again, where we practice gratitude because I think it's just so important. And so I think
powerful.
I say I'm grateful for that right there. Just the opportunity to take a step back to recognize how important gratitude is. I'm grateful for gratitude.
That's so funny. That's totally like we call him Pop Up here. That's his nickname on our team because it's like, an old soul. But true. I was like, what are you grateful for? And you're like, my new system of expressing gratitude on a regular day in a written format.
Got it all figured out. Yeah, exactly.
I'll say, and I'm trying to come up with a different one for each episode, so this will be fun.
Oh, man, that's a challenge.
I really think just my health, overall health. I think that's just a hard thing because sometimes people don't have it and it's just out of your control. And so while you have it, I'm just really, really grateful for it.
It's easy to take it for granted.
It is easy to take for granted. So thanks for being with us today.
Absolutely. Yeah. Thanks for having me. It's been a blast. Yeah. Good stuff to talk about.
Thank you for tuning in to the Money Pig Podcast. We hope you enjoyed today's episode. To stay updated on new episodes, be sure to subscribe wherever you listen to podcasts. If you found value in today's discussion, we'd greatly appreciate it if you could leave a rating and review. If you have any questions about the topics we covered, feel free to visit us at goodwininvestment.com and reach out. This episode is produced by evance.net. This podcast is provided for informational purposes only and should not be considered as investment advice, a solicitation to buy or sell any financial products, securities, digital assets, or other investment vehicles, nor as a basis for making any financial decisions. Goodwin Investment Advisory is a registered investment advisor with the SEC, CRD number 131193. Please note that the host and or guests may personally own securities, digital assets, or other investments mentioned in this podcast. Investments carry risk and are not guaranteed unless stated otherwise. We strongly recommend consulting with a qualified financial advisor, tax professional, insurance professional, and or legal professional before implementing any strategies discussed in this episode. Lastly, past performance is not indicative of future results.